Yeah, now let's get started with the fixed income securities, whose weightage from an exam standpoint is almost 12%. So, one of the heavyweight subjects, but only 8 chapters altogether, right? And the first three, 4 chapters are more theoretical, and the remaining three, 4 chapters have some kind of calculations involved in them. So, as we talk about fixed income, it's more to do with the bond market as well as the loan market, because whenever we talk about the bonds, they are assumed to be the instruments which pay a fixed interest rate. In case of equities, there is nothing fixed, right? Whereas when we talk about a loan or bond, there is a fixed income payment that is paid. Interest is fixed at the beginning of the contract itself, right? So even when we talk about a loan, to a large extent the interest is decided at the beginning itself. So that's where we typically classify the bond market and the loan markets. Borrowing, anything to do with the borrowing, even if I take a floating rate loan also, or even if a company issues a floating rate bond also, they are typically still classified as a part of the fixed income securities market itself. So when we are looking at the key features of these fixed income securities, anytime we talk about a bond, we talk about the obligations. So as someone who is issuing a bond, let's say L&T has issued a bond, there will be some mention about the obligations what L&T will be paying to its investors. Okay, there is a, a principal payment that would happen after 5 years, but within the period some interest payments will be there. So that is what is the obligation. The company is obligated to pay some fixed interest every year, and some principal at the end of the maturity period. Those are the obligations from the company. The rights, in case the company does not pay all this, what what happens to the investor? Can he take some control over the assets of the company? If yes, what assets can he take the control of? The rights which the investor will be having. Options that are available. Is the bond callable? Right? Can the company call back the bond? If so, at what frequency? After how much time can they call back the bond? Or at what price they can call back the bond? All these things will be mentioned in a document called the bond indenture, which is as good as the prospectus for a bond, which will contain all the responsibilities of a company which is issuing the bond to the investor. So, in the indenture, there will be something called covenants for a bond. Covenants are like do's and don'ts. Right? What should the company do? Which are called as affirmative covenants. What should the company refrain from doing? Which are called as the negative covenants. Like which is saying the actions which the borrower should perform. For example, you may say you may have to maintain a debt equity ratio of 2, or the company has to maintain a EBIT to I times interest earned ratio of at least 1.5. These are like the things to do during the bond period. Or there are some don'ts. The company cannot issue or cannot pay dividends in excess of this much amount. Because if very heavy amount is paid in the form of dividend, very less is retained. Less is retained means next year growth will be hampered. Next year growth hampered means probably the interest, the potential for the company to pay interest next year will get hampered. So that's where they may say, they may put these kind of restriction. The dividend that you are declaring should not exceed this much. Or they may say you cannot raise a new capital without the permission from the existing bondholders. So these are like negative covenants, which the company should not do. So when an investor is investing in a bond, he has to read through the complete indenture. And only then he can decide whether he has to invest in it or not. See, it's not as a simple FD. Okay, you pay this much, after 5 years you will get this much. That's the only thing that is there as a part of the FD. Though FD is also a kind of a bond, but it is very simple. Whereas the typical bonds that are available in the market today, they are fairly complex. Right? So there are so many things which are from the perspective of obligations from the company, and also the do's and don'ts of the issuer with respect to this bond, as long as this bond is in existence. Now every bond has few things. There is a maturity period. In equity there is no maturity, it goes as a going concern, infinite. That's where in all our valuations we have used infinite period kind of thing. Whereas in bond there is no question of infinite. Bond always has a definite period, which is what is called as a maturity. And then the bond, just like equity, bond also has a face value, which is otherwise called as your par value. We have looked at in our long term liability. Right? If the coupon is less than the par value or face value of the bond would be selling at a discount. Coupon is more than the face value, it would be selling at a premium. Right? So the par value is the face value of the bond. Typically it is how much will be paid on maturity. It's like a principal that would be paid on the maturity. That is what we are calling as the par value. Then we have coupon, which is primarily the periodic payment, how much the company will pay every year. It could be more than the interest rate, it could be less than the interest rate. If it is paying more than the interest rate, obviously there will be more demand for the bond. That's where the bond will be sold at a premium. If it is paying less than the interest rate, so there will be less demand for purchasing that bond. So that means it would be sold at a discount to the par value. So whatever is the periodic interest that would be paid on the principal amount, that is what we are calling as coupon. Sometimes it is annual coupon, sometimes it is a semi-annual coupon, right? Or it could be a zero coupon also, which means no coupon would be paid until the maturity, just like our FD. In our FD, there is no coupon, no intermediate payment until the maturity date. Whereas in some cases or in some kind of bonds, there are regular payments every year and a principal will be returned on maturity period. And even that coupons, though in a large number of instruments they are fixed, they could be floating also. Right? Then we also talk about option free bond, or typically otherwise called as non-callable bonds. Which are the most regular bonds? Non-callable, option free, straightforward bond. Which is nothing but it will pay some fixed amounts every year and some principal on maturity. That's a very straightforward bond. But today that straightforward bonds are very few in nature. They are complicated a lot. With that complications, there could be callable bonds, there could be convertible bonds, there could be various other forms in the bond. And even zero coupon bonds, which are like nothing is paid in the intermediate, everything is paid on the maturity itself. So because the regular payment is much lesser, obviously they should be sold at a discount to the par value itself. So zero coupon bonds are always sold at a discount to the par value because the coupon is less than the interest rate. Wherever you find coupon less than interest rate or coupon less than yield to maturity, you will say that the bond will be sold at a discount. Coupon more than yield to maturity, it will be sold at a premium. Coupon equal to yield to maturity, the bond will be sold at a par value itself. Now there are some other types of things with respect to coupon. There could be step-up notes. Step-up notes is more like, okay, first few years will pay this much coupon, very small coupon. But after a couple of years, we'll pay a higher coupon. After some more years, we'll pay slightly more higher. So it's like phase-wise increment in the coupon. Instead of fixed or floating, see, typically companies which want more money in the initial years, right? Because they'll pay only a small coupon every year, but a bigger coupon towards the later years. So in the initial years, they don't have too much of an expense from their side, because they are paying only a small, so they can retain more cash. Probably they can use it for their business more effectively, especially if they are issuing with step-up notes. But there is a drawback. Investors may not be interested in that. First few years, getting a very small money, why should I be investing? So there is always the investor's angle as well as the issuer's angle in all these things. So depending on from whose perspective we are evaluating this decision, we would be applying that appropriate analysis. Then we can have a deferred coupon bond, which means initial years no coupon, not step up. First few years almost zero coupon. Only if the coupon will start paying from the 5th year onwards or something. I am deferring the payment of the coupon. So whatever is, let's say first year I have to pay some 10 on face value of 100. 3 years I don't pay. So that 30 gets accumulated. 3 years, in case of deferred coupon, first 3 years, let's say I am not going to pay any coupon. Whatever is applicable for that 3 years, let's say 30, it is paid either as a lump sum in the 4th year. The whole 30 is paid along with the 4th year's one, or the 30 will be equally distributed for the remaining period of the bond. Let's say the bond is still existing for 5 more years. 8 years bond. First 3 years, no payment. So the 30, whatever is accumulated, they'll try to spread it over the remaining 5 years. So which means 6 per year. Apart from the 10 of that year, you will receive 6 of that year also. Sometimes it could be even accrued along with interest. See, this 3 years you are not paying any interest. So the interest has to be applied on that, because you are foregoing. If you are receiving 10 now and you receive the 10 after 4 years, then they are not of the same. So you will apply the time value of money. So this 10 is worth probably 13 after 3 years. So based on that, you will compute and try to distribute it over the remaining 5-year period, which means you are applying the time value of money funda in that process and trying to pay. So it could be either paid as a lump sum, or it could be paid even in as a equal installment from then till the maturity. So those are also some kind of bonds that are issued in the market. Or there could be a floating rate bond, which means the coupon is completely variable. It is linked to some reference rate. Probably it could be, I can say, okay, a 1-year FD rate. Or most commonly it is a LIBOR. LIBOR is the interbank operating rate. So the rate at which the banks borrow and lend among themselves, that is used as the core source of variable rate. Now, generally what people say is, okay, LIBOR plus 3%. Some percentage they will put to that. LIBOR is taken as a variable rate. Now, depending on the risk, because the interbank transfer generally is treated as the risk-free in the banking world. The rate at which banks borrow and lend, interbank, that is generally treated as a risk-free. Now, not all of us may not be having similar levels of risk-freeness, or not all corporate will have same level of risk-freeness. So, depending on the riskiness associated with those corporates, the percentage will be added to that. LIBOR plus 3%, or general terms that are used is LIBOR plus 200 basis points. $200 basis points is nothing but 2%. So every 100 basis points is like 1%. So 1 basis point means 0.01%. So you can convert it accordingly. So, but the common terminology that is used is in terms of basis points rather than in terms of percentage. So LIBOR is used as a typical variable rate basis, and plus or minus something is what generally done to accommodate the risk of the other parties. And in that floating rate also, Not just the floating rate. Whatever is the LIBOR plus 2%, that's a regular. But in that, so what if the LIBOR goes to 10%? Again, virtual cases, but yes, if the LIBOR goes very high, then the company has to pay a very high amount, right, as an interest, because we are talking of coupons are completely floating. Whatever is the LIBOR, based on the LIBOR, the coupon will be paid. If the LIBOR goes much higher, the company has to pay a very high interest. It will impact the profitability of the company. So that is where they can set a cap. Anything above 10% will pay only 10%. Otherwise, if it goes, let's say we are taking a loan. We say we will take a floating rate loan. Floating rate loan means what? Whatever is the interest rate that is applicable in the market at that point, whatever is the home loan rate that is applicable in the market, I'll have to pay as per that rate. Right? Okay, if it is 7%, I'll pay 7%, 8%, I'll pay 8%, 9%, I'll pay 9%. But if it goes to 20%, I have to pay 20%. That will be a big problem for me. That's where I can take a cap on that. Anything above 12%, I'll pay only 12%. That is as good as a call provision. We'll talk about that. So that is as good as taking a call provision on that. Right? So companies can very well go with a cap. Anything above this, only this much will be paid. Similarly, the floor will be there. Floor will be generally taken by the investor. Because if the floating rate comes down to 2%, LIBOR is 1%, 2%, the company will pay only 3% or something. LIBOR plus 2%, let's say if I say, if the LIBOR is 1%, then the investor will be receiving only 3% from the company as an interest. So in that case, it would be a big loss to the investor. It might be very comfortable for the company, but it would be a big loss to the investor. In that case, he can take a floor. Okay, floating we are fine. But if it goes below 5%, you still have to pay 5% to us. That's like a floor. There is a minimum value that needs to be paid. So these kind of things would be laid down as a part of the indenture. Whether there is a callable provision, whether there is what is the floating rate, coupon rate, even if it is floating, is it fully wide open? Or there is a scope for a cap and a floor? Or is there only a cap but no floor? All these things will impact the buying decision. So though we use the word fixed income, nothing is fixed here. Right? That's one thing. Compared to equity valuations, fixed income valuation is a very, very tough task because of that. Equity is straightforward. You assume companies will exist forever. All only infinite period valuations. Whereas in case of fixed income, all these things make the securities more and more complicated. Right? And interest rates fluctuate only between, let's say, 7% to 10% or 11%, not too much of fluctuation itself. So a small change in the interest rate will have a very big impact on the overall profitabilities. So evaluating all these things will become a very tough task. Or if there is a cap provision versus a full floor provision, which one is benefit, or how much extra should I pay for this? Right? I'll give you one example. Last year, I've seen two different ads. I don't know whether I have covered this with you earlier or not. Last year, with just a 15 days gap, I've seen two different ads. One of a big gold loan company issuing bonds, and one about a government power company issuing bonds. A gold loan company has set 12.25% interest. Right? And this power finance company, they have mentioned it as 9% interest. Now, which one should the bond investor look at? The gold loan company is saying we'll give 12.22 different ads on the same page. Gold loan company saying 12.25% is what is the interest we'll give. This company saying we'll give 9% interest. There's a big challenge in that. And in the ad, they won't give anything more than that. But when you open up the prospectus, you will find for this bond there is a callable provision. For the 12.25% one, there is a callable provision, which means whenever the company wants, it can call back the bond and reissue it at a lesser interest rate. Generally, the company